Right now, local Chinese investors are pouring $25 billion into a sector that the rest of the global financial world is just, well, running away from in terror.
Absolute terror, yeah.
Right. So what do the locals know that Wall Street doesn't? Are we looking at, the deep value bargain of the decade, or is this just a classic heartbreaking value trap?
It's the ultimate question.
It is. It's the ultimate question in investing. And right now, there is one specific asset where that question is completely tearing the financial world apart. We're talking about the KraneShares CSI China Internet ETF.
Also known as KWEB.
Right, KWB. And if you follow financial news, you are probably getting severe whiplash from the headlines right now.
Oh, totally.
Because on one hand, this ETF is riding a brutal falling trend, right? Lingering sell signals everywhere. But on the other hand, you have analysts out there literally screaming, strong buy, calling it this massively undervalued, once-in-a-generation opportunity.
It is the absolute definition of a polarized market. I mean, you have two completely different realities trying to occupy the exact same space on a stock chart.
Yeah.
And it's creating just extreme volatility.
So our mission for this deep dive is to take a massive stack of data, financial reports, technical charts, market sentiment data, and figure out exactly what is going on beneath the surface. We are going to look at the raw numbers, the technical momentum, and that massive global tug-of-war happening right now.
Yeah, and before we get into the weeds of those charts and numbers, it is crucial to remind you that while we're going to explore both the bull and the bear cases today in depth, this is an educational exploration of the data.
Right, exactly.
We are looking at the mechanics of the market to understand why things are moving the way they are. This is absolutely not financial advice.
No, definitely not. So let's unpack this. Before we get swept up in the drama of moving averages and geopolitical headlines, we need to know what we are actually looking at.
Right.
What is the basic blueprint of KWE, and what do the raw fundamentals look like right now in mid-April 2026?
So to start with the blueprint, KWE is an ETF designed to give you targeted exposure to China-based companies whose primary business is internet-related technology.
Okay.
So we are talking about e-commerce giants, search engines, social media networks, gaming companies.
The big ones.
Exactly. The digital backbone of the Chinese economy. Companies like Tencent and PDD Holdings, they are the heavyweights inside this fund.
And looking at the price tag, things get really intense.
Right.
As of April 15, 2026, the current price is sitting right at $29.37.
Which is dangerously close to its 52-week low.
Right. The low is $27.62, and it's a massive fall from its high of $43.37. But despite that drop, I mean, this isn't some small, forgotten fund, right?
Not at all.
It still holds roughly $6.04 billion in assets under management.
That is exactly right. It's a heavyweight fund. And if we look a bit deeper at the fund's mechanics, the net asset value, or NAV, is sitting at $28.73.
So for the listener who might just look at the stock ticker price, what does that NAV actually tell us in this specific context?
Well, the NAV is essentially the true baseline value of the fund. Like if KWE were to liquidate every single share of Tencent, PDD, and all its other holdings today at their current market prices.
Just sell everything.
Exactly, sell it all. That number is what a single share of the ETF would actually be worth. And because the market price of $29.37 is tracking fairly close to that $28.73 NAV, it tells us the ETF is pricing efficiently.
Oh, I see.
Yeah, it isn't trading at some wild premium or discount to the assets it actually holds.
Got it. That makes sense. And I also see an expense ratio of 0.70%. Is that something a prospective buyer needs to worry about?
I mean, an expense ratio of 0.70% means you are paying $70 a year in fees for every $10,000 invested.
Okay.
That is certainly on the pricier side if you compare it to, say, a standard passive S&P 500 index fund, which might charge practically nothing.
Right.
But it is very typical for specialized international funds. It takes significantly more effort and resources to manage those underlying foreign assets.
Okay, so that is the carrying cost.
Yeah.
But let's talk about the valuation, because this is where the screaming buy analysts are planting their flags.
Oh, yeah. The valuation numbers are wild.
They really are. We're looking at a trailing PE ratio, price to earnings, of around 12.98. And then you have this massive dividend yield hovering between 7.14% and 7.30%.
Which is huge.
It is. They even declared a hefty $2.10 dividend back in late December of 2025.
Yeah.
So looking at a tech-heavy fund with a PE under 13 and a yield over 7%, it's like walking past a high-end electronics store with a giant 70% off clearance sign in the window.
That's a great way to put it.
You look at it and think, this is either the greatest shopping deal of my life or this store is going bankrupt tomorrow.
Exactly. That is a brilliant way to frame it. And if we explore why those specific numbers are making value investors salivate, we really have to look at the global context. When you look at equivalent tech companies in the United States, you are routinely seeing PE ratios in the 30s, 40s, or even much higher.
Oh, easily.
Right. So a PE of 12.98 for established internet and technology growth companies is at historic lows.
Meaning you are paying a fraction of the cost for every dollar of profit these companies generate compared to what you'd pay for an American tech company.
Exactly. It forms the absolute bedrock of the deep value argument. The math simply suggests these companies are fundamentally cheap based on the money they actually make.
Right.
And that 7% dividend yield, that means you are being paid quite handsomely to just sit in the stock and wait for the price to recover.
It sounds almost too good to be true on paper. But, paper fundamentals don't always translate to the reality of the trading day.
No, they definitely do not.
Because if the fundamentals are so incredibly cheap, why is the price still struggling so badly?
Well, because while the fundamentals might look like a clearance sale, the actual price action on the charts tells a story of intense psychological struggle. This is where we have to shift the conversation from value to momentum. Technically speaking, KWB is locked in a broad downtrend. The current price is sitting below its major moving averages.
Let's talk about those moving averages.
Yeah.
Because we hear terms like support and resistance all the time. But those lines on the chart aren't just arbitrary math, are they?
Not at all. Those technical ceilings and floors on the chart represent actual human behavior. And in many cases, honestly, human trauma.
True.
Trauma, yeah. A moving average maps out the average price over a certain number of days. It shows us exactly where buyers and sellers historically step in.
Right.
Right now, the 50-day simple moving average is sitting at $28.59. That is acting as a short-term floor or support, is where short-term traders are stepping in and saying, okay, it's cheap enough, I'll buy.
But looking up, we have the 200-day simple moving average looming overhead at $35.93.
Yes. That is acting as major heavy resistance, a real ceiling.
Wow.
Think about the psychology there. You have investors who bought in months ago at $35 or higher. They have watched their investment just bleed out.
Yeah, just brutal.
So now, every time the price even gets close to that $35 mark, those traumatized investors hit the sell button just so they can break even and get out of the trade.
Oh, that makes total sense.
And that creates massive selling pressure.
So we are completely sandwiched right now.
Yeah.
There is immediate support below at $29.09 based on accumulated trading volume, and then that critical 52-week low at $27.62.
Right.
But looking up, immediate resistance is at $29.49, and then there's a huge psychological barrier at $30.
That $30 mark is a brutal battleground. Round numbers almost always are in trading because human beings just think in round numbers.
Sure.
But this specific zone is where the momentum indicators, the technical signals that traders use, start sending out incredibly conflicting messages.
Oh, so?
Well, for instance, the NASCD is currently flashing a buy signal at 0.20, and the 14-day relative strength index, the RSI, is currently sitting at 68.21.
Wait, I want to pause to make sure we don't lose anyone in the technical alphabet soup here.
Fair enough.
Let's break down what MCHI and RSI are actually telling us about the people trading this stock.
Absolutely. Let's start with the RSI, the relative strength index. It simply measures the speed and size of recent price changes. The scale goes from 0 to 100.
Okay.
When it drops down to 30, it usually means the sellers are completely exhausted. It is considered oversold, like nobody is left to hit the sell button.
Right.
Just recently, KWE's RSI was hovering right near that 30 line. But today, it has shot up to 68.21.
So it just experienced a very sharp, aggressive bounce from the absolute bottom.
Yes.
And the MACD.
MACD measures the relationship between two moving averages to gauge momentum. When shorter-term momentum crosses above the longer-term trend, it flashes a buy signal.
Which is what we are seeing right now.
Exactly. It suggests short-term momentum is shifting upward.
I have to play devil's advocate here, though. Because if you're listening to this and thinking, why would I catch a falling knife?
Yeah.
You aren't alone.
Oh, for sure.
These mixed signals sound terrifying. I mean, we have an RSI that just shot up from the basement. We have a MACD buy signal flashing. We have a short-term bounce off the lows.
Yeah.
But we are still fundamentally trapped under that massive 200-day moving average ceiling of $35.93. To me, it sounds exactly like trying to jump on a trampoline in a room with a 5-foot ceiling.
That is
Like, sure, you have great upward momentum from the trampoline, but you're just going to hit your head incredibly hard on that ceiling.
That is a phenomenal analogy. It perfectly captures the mechanical difference between short-term tactical strength and long-term structural weakness.
Right.
The trampoline bounce, that sudden move from an exhausted RSI of 30 up to an aggressive 68, is the tactical strength. Nimble traders see the oversold condition, they see that $28.59 support holding, and they jump in for a quick gain.
But the ceiling is still there.
Exactly. That 200-day moving average ceiling represents the structural weakness. It is the long-term reality that over the course of the year, sellers have consistently overpowered buyers at higher prices. The structural trend is still pointing down.
Which naturally leads to the next question.
Yeah.
Who exactly are the people jumping on the trampoline, and who is standing on the ceiling pushing the price back down? Because those charts are drawn by a massive ongoing tug of war between two very different groups.
And this is where the data gets fascinating. If we look at the order flow, we are seeing one of the most dramatic geographic splits in market sentiment you will ever encounter.
Okay, let's look at the buyers first.
Through the Southbound Stock Connect, which is the trading infrastructure that allows investors in mainland China to buy Hong Kong-listed equities, we are seeing aggressive, massive buying.
How massive?
Mainland investors have poured a net $25 billion into Hong Kong-listed ETFs like KWEB just since the start of 2026.
Oh, wow. $25 billion in just a few months.
Yes.
I mean, that is not retail traders casually dipping their toes in.
Yeah.
It is immense conviction.
It is absolute conviction. But on the exact opposite side of the rope, you have foreign institutional money, the global smart money.
And what are they doing?
They are terrified. They are largely staying away, liquidating positions, and citing severe geopolitical risks.
Now, there are always a few exceptions, right?
Mm-hmm.
The data notes that the hedge fund Appaloosa Management is still holding a massive $162 million position in the fund.
True.
And if you look at the options market, there is very high call option volume at the $31 and $32 strike price.
Right, right.
And for those unfamiliar, a call option is just a bet that the price will go up.
Okay.
So that volume shows that at least some traders are wildly optimistic for a short-term breakout above that $30 psychological barrier.
Yes, the options market is definitely pricing in the potential for that trampoline to keep going. But the overarching macro narrative is still mainland buyers relentlessly acquiring shares while foreign sellers relentlessly dump them.
Which brings us back to that $25 billion question from the very beginning.
Exactly.
If the massive global institutions are running for the hills, why are mainland Chinese investors backing up the truck to buy this ETF?
Yeah.
What do they see that a Wall Street fund manager doesn't?
Well, it fundamentally comes down to information asymmetry.
Meaning what exactly?
Think about the proximity to the actual day-to-day technological reality of these companies. A mainland investor is using Tencent's ecosystem every single day.
Right.
They are buying groceries on PDD. They are seeing the AI integration firsthand in their daily lives. They are looking at the micro-level reality of these businesses and their dominance in the consumer market.
While the Wall Street manager is looking at a Bloomberg terminal reading scary headlines.
Precisely. Foreign funds are often paralyzed by external macroeconomic noise. They see the geopolitical headlines and they hit the sell button. But the local buyers clearly believe the intrinsic value of these tech monopolies heavily outweighs the external risks.
This stark division really brings our deep dive to its ultimate focal point, the battle between the bull case and the bear case.
Yeah.
Is this a misunderstood, undervalued gold mine, or is it a dangerous trap? Let's break down the bull case first.
So the bull case relies on three main pillars. We already discussed the first one, which is deep value.
Right, the low PE ratio.
Exactly. Those historic low PE ratios compared to U.S. tech are incredibly compelling for long-term holders. The second pillar is the anticipation of stimulus.
Ah, okay.
There is widespread expectation of massive liquidity injections from Beijing to stimulate the broader economy. And historically, when central banks pump liquidity into a market, risk assets like tech stocks are the first to soar.
And the third pillar is the technology itself, right?
Yes.
Because according to the research, there is a growing perception that China's artificial intelligence progress is catching up rapidly.
Very rapidly.
Perhaps only months behind the U.S. now. And if the global market suddenly realizes these companies are neck and neck with Silicon Valley on AI development, a 12.98 PE ratio is going to look absurdly cheap.
Which is likely why the aggregate analyst ratings for KWE's top holdings are sitting firmly between a hold and a strong buy right now.
Wait, really? even with the price so low.
Yeah, if you look at PDD Holdings, the consensus rating is a 2.33, which categorizes as a strong buy. Tencent is sitting at a 2.43, which is a solid buy rating.
Wow. Those are incredibly strong fundamental ratings for companies residing inside an ETF that is struggling near its 52-week low.
They really are. But, the bear case is equally compelling.
Right.
And it forces us to look away from the technology and focus entirely on the macro environment. First, there is the severe negative momentum on the charts. KWB is lagging the S&P 500 significantly.
Oh, definitely.
Second, there is ongoing internal regulatory pressure and uncertainty regarding Chinese government policy shifts toward the tech sector.
And then there's the elephant in the room. Massive geopolitical risk.
The biggest elephant.
Specifically, we're looking at data regarding U.S. tariff threats of up to 125% on certain Chinese goods. Now, I have to ask this because I get why tariffs hurt a company exporting physical goods like, steel or washing machines.
Sure.
But KWEB is an ETF holding software, e-commerce, and gaming companies. Why would tariffs on physical exports crash an internet ETF?
It is a phenomenal question, and it's all about the economic domino effect.
Okay, walk us through it.
Tariffs on physical goods lead to a broader slowdown in the entire Chinese economy. So when factory owners are making less money and workers are facing layoffs, consumer spending drops across the board.
Right, people have less money to spend.
Exactly. If consumers tighten their belts, e-commerce platforms like PDD see a massive drop in sales volume. Furthermore, if companies are struggling, the first thing they cut is their advertising budget.
Oh, of course.
Which directly kneecaps the revenue of social media giants like Tencent.
Yeah.
So even though KWE companies don't export physical goods, they're highly sensitive to the health of the domestic consumer.
Which is threatened by those tariffs.
Exactly.
That makes perfect sense. The internet economy runs on consumer cash flow. And to be perfectly clear to everyone listening, the market doesn't care about the politics behind these tariffs or regulations.
Not at all.
We certainly aren't taking a political side or endorsing any government's policy here. We are strictly looking at the math of fear. The market reacts to the gravitational pull of policy threats, regardless of who is issuing them.
Exactly. The market is a discounting mechanism. It prices in the worst-case scenario impartially.
And when you put it that way, it totally changes the clearance sale analogy we used earlier.
How so?
Well, it's not just a TV on sale. It's like buying a heavily discounted, beautiful luxury home that was built directly on a tectonic fault line.
Wow. Yeah.
Like the fundamentals, the house itself, the PE ratio, the dividend, they look beautiful.
Yeah.
But the geopolitical fault line beneath it could swallow the entire investment in an afternoon.
That is perfectly said, and that is why retail traders so often get wiped out here.
They just see the price tag.
They look at the cheap price, but completely ignore the macro volatility. And that is exactly the mechanism of a value trap. It is what technical analysts call getting caught in a falling channel.
Okay, what is a falling channel?
A falling channel happens when the price makes lower highs and lower lows consistently over time. So a retail trader sees the stock hit the bottom of the channel and thinks, this is it, the reversal.
Right, they buy in.
Exactly. They buy in. The stock rallies up to the top of the downward channel, which, by the way, is still lower than the previous peak. Wow. And then it just crashes down to a brand new low.
The trampoline hits the lowering ceiling.
Exactly. The downside risk here isn't just that the stock goes down, it's the psychological exhaustion. You are subjected to extreme, violent volatility.
Right.
Rapid rallies, crushing sell-offs, all while the long-term trend remains structurally broken.
It is a brutal environment to navigate. So pulling all of these threads together, the cheap fundamentals, the moving average ceilings, the $25 billion in mainland buying, and the overarching threat of macro tariffs. Where does that leave the outlook for KWU?
Well, it leaves us with a split outlook, depending entirely on your time horizon.
Okay, break it down.
In the short term, meaning the next few days to weeks, many technical traders see a tactical long setup. They are playing that trampoline bounce based on the oversold RSI.
And what's their target?
Their target is a move up to $31.50, driven by those call options and the relentless mainland buying. But, and this is a big but, that entire short-term thesis is strictly dependent on that support level at $28.50 holding firm.
If $28.50 breaks.
If $28.50 breaks, the floor falls out.
Wow. And the medium to long-term outlook?
It remains highly cautious. The technical breakdowns we saw earlier in 2026 below those key moving averages have caused significant technical damage to the chart.
Right.
Until KWEB can break through that heavy 200-day moving average ceiling at $35.93 and do it on massive trading volume, the long-term trend remains in a defensive downward posture.
So if you are a nimble trader, you might see a quick tactical play. But if you're a long-term investor, you're basically staring at a luxury home on a fault line.
You really are. But, this raises one final important question, though. It is something crucial to consider as you digest all this data.
What's that?
Well, we have spent this entire deep dive zooming in on KWEB, looking specifically at the hyper-focused internet tech sector. But zooming out, it leaves you with a much broader puzzle to solve about portfolio construction.
What kind of puzzle?
Well, if this specific tech sector is acting as a lightning rod for all this extreme volatility, regulatory pressure, and geopolitical risk, how does a broader approach compare?
Oh, I see where you're going.
Right. Would looking at KWEB's broader peer, like the iShares MSCI China ETF or MCHI, which holds companies across multiple sectors of the entire Chinese economy, would that dampen the storm by spreading the risk around?
Yeah.
Or by buying into the broader economy, does that just widen the target on your back?
That is the exact kind of question that separates a reactionary trader from a deeply informed investor. So as you look at your own portfolios, watch these moving averages and follow the headlines. Ask yourself if the hyper-focused deep value of KWEB is worth the concentrated risk, or if stepping back changes the entire equation. Keep questioning the charts, keep digging into the mechanics of the data, and never let the external noise drown out the actual numbers.